Everyone repeats the same financial wisdom: buy low, sell high. Amazing advice, truly groundbreaking. Except nobody can tell me where low actually is or where high is supposed to be. Every time I try to buy the dips come with the secret dip underneath it. Eventually, I got tired of guessing, and that's where the strategy came from. Before I could do anything, I needed to answer one question: is the stock actually bullish or just faking bullish for a candle or two? When it's genuinely bullish, I should get a green arrow. When it flips bearish, I should get a red arrow. Sounds simple? Wrong. Just saying buy green, sell red is the trading equivalent of buy low, sell high. It sounds smart and tells you absolutely nothing. So the arrows needed logic behind them. For that, I needed indicators, equations I could feed real conditions into. I went indicator hunting. I dug through way too many options, or in plain English, I asked Claude and it hit me with the laundry list. I didn't need 50 indicators, so I picked three that mattered the most to me: SMA, MACD, and RSI. After coding and backtesting, the rules I ended up with: for a buy, RSI must break above the highest RSI in a specific lookback, SMA must be above the prior SMA, and MACD is above the prior MACD. When all three line up, it shows that momentum is pushing. For a sell, it's the same logic but inverted. RSI must break below the lowest RSI in a specific lookback, SMA must be below the prior SMA, and MACD is below the prior MACD. Backtested results came back at around a 61% win rate with a 3-to-1 risk reward. So at this point, I'm thinking, all right, this might actually be something. Maybe I cracked it. We're all going to be billionaires. Then the 2020 showed up. The COVID crash took my shiny momentum strategy and threw it off a bridge. Watching that sell off burn through everything made one thing crystal clear: having entries is cute, but not having a risk management is suicide. My account and my sanity could not survive that crash. Because of that, I added something called the cloud. It's built from price highs and lows, and it lets me trail risk without micromanaging every candle. That one change kept the strategy from getting nuked during volatility. With that strategy finished, it was time to see if it could actually survive the real world. Running it on SPY, we get a 58% win rate with an almost 4-to-1 win-loss ratio. Scrolling back through history, you can see something interesting. The strategy's sell signals line up almost perfectly with the major market crashes. And here's the real beauty: I can use this information for my other strategies. If the market is bullish, I know it's prime time for momentum trades. If it's bearish, I can flip the switch and look for short opportunities. It's a two-for-one deal. But SPY isn't the only test. Let's scroll through a few more tickers. QQQ, 56% win rate with a 3-to-1 win-loss ratio. AAPL with a similar 54% win rate and a 3-to-1 win-loss ratio. CSLA, 41% win rate with a 22-to-1 win loss ratio. And honestly, this win ratio is absurd. I mean, some of it has to do with the volatility. Tesla wild swings helps the strategy make a ton of money. We're being transparent here, so let's look at something the strategy did not handle well. Here's the completely random penny stock, ZNOG. Yeah, not great. No strategy has a perfect win rate across every market condition and every ticker. And to be honest, I would never trade names like this anyway. This strategy wants direction, and direction is a lot more consistent in large caps and major ETFs than it is in low float lottery tickets. Looking at ZNOG recent trades, you'll notice a pattern. Once the strategy gets in, the stock tends to go ballistic. It just overstays its welcome on the exits. That's just a mismatch between the tool and the environment. Now you could build scanners and tweak the logic to capitalize on this type of move. People do it all the time with breakout micro strategies. In general, this strategy has a solid track record on the big names. Sure, you could try to trade penny stocks, but I'm not one for dumpster diving. Important thing to keep in mind: you don't have to trade exactly like I do. You can strip out the entries and exits and simply use it as a gauge whether a stock is worth adding to your positions. Now, to showcase what this thing can actually do as a trend indicator, I'm going to run a second strategy alongside it. On the daily time frame, I'm running the strategy we built today, basically our phase detector. And on the 5 minute time frame, I'm running one of my momentum strategies. Recently, the phase detector has been calling an uptrend on the daily chart, and sure enough, the 5 minute momentum strategy has been printing solid trades, clean entries and clean exits. But let's scroll back to the time when the phase detector said we were in a downtrend. Instantly, you can see the difference. The same 5 minute momentum strategy performs significantly worse: more fake outs, more noise, and more stop outs. The key point is we would have avoided all of that. The phase detector would have warned us ahead of time that the conditions weren't favorable for momentum. Right now, I'm actually in a live trade using this. I bought SSSO about 7 months ago and I'm up roughly 21%. Not life changing, but very solid for an ETF. I'll post updates in the Discord and the full code will be there too. Till next time.